Now, when it comes to investing in the stock market, there's going to be various risks depending on whether you buy into different ETFs, different stocks, etc. But in this video, we are going to go through a risk-free method on how any investor like you or I can receive a massive amount of yield on a yearly basis for literally no risk at all. Now, before we get into that, I wanted to mention that risk isn't always a bad thing. If you would have bought into the S&P 500 over multiple different time frames, for example, when it seemed like it might be the riskiest thing of all to invest into, times when the S&P 500 was down 10, 20, or 30%, let's say. If you would have bought into the S&P 500 even the entire way down and then just held on to the S&P 500 over a span of say 5 or 10 years, all that risk would have paid off and you would most likely be very, very happy with your returns. But for the investors like myself that might have some idle money sitting on the sidelines that they are not willing to risk at all, well, this could be the perfect situation to do so because low risk or no risk fixed income options are now available, offering massive amounts of yields because of the fact that the interest rates are still so high. You see, the higher and higher that interest rates go, the higher and higher that fixed income yields go, which means that for investors interested in buying into things like CDs or certificate deposits or even US Treasury bonds, there is a ton of yield to be made as of right now. For this video specifically, we are going to be looking at different CDs, and these CDs specifically are on the Fidelity platform, which we're going to look into, but also you can go to bankrate.com or just Google top paying CDs, and there's tons of different banks and brokers that are offering a ton amounts of APY as of right now due to interest rates skyrocketing. So first, maybe let's talk a little bit more about why even invest into something like a CD through a brokerage. Now, brokered CDs are pretty nice because if you already have a stock market portfolio per se on the Fidelity platform or TD Ameritrade or any of the other brokers, you can normally buy brokered CDs right through the platform and it keeps everything nice, neat, and all together. But when it comes to CDs, as of right now, you are going to see different amounts of interest being offered on different time frames, and this has a lot to do with whether or whether not interest rates are going to remain sustained higher for longer or move down in the future. Now, for example, when it comes to CDs, for 3 months till maturity, right now a 5.45% is the highest amount of interest being offered. On the 6-month maturity, 5.45% also. But if you go out 9 months, if you have your money locked into a CD for a little bit longer, you're looking at 5.6%, and even 1 year, 5.7%. Now, for most investors out there, we'd be pretty happy with say 6, 7, 8, 9, 10% return per year. But of course, that's going to come along with some risk. And like we showed earlier on the S&P 500, there's going to be multiple different time frames where you might be in the deep red when it comes to the stock markets. So CDs come in pretty handy because you are not going to be in the red when it comes to a CD. You're buying into this fixed income and you are going to get paid a set amount of interest, regardless of what happens in the stock market during the duration of your CD. Now, even a little bit further out maturities, 2-year, 3-year, 5-year, and 10 years, these are between 5.5 and 5.6%. But just for this video's sake, let's look into this brokered CD at 5.7% and see what it looks like. So once again, this is inside the Fidelity platform, but pretty much all brokerages are going to have something very similar. So it says right here, as of right now, the JP Morgan Chase is offering a 5.7% CD, which is going to pay out at maturity. The maturity date is around a year from now. It is not a fractional CD. The yield is 5.7%. And with this specific CD, there is not going to be any call protection. Now, call protection basically just means that the issuer, in this case, JP Morgan, is going to actually be able to call the CD early. A lot of times it's like 3 or 4 months away from when you open the CD. So in that case, you are going to be at risk of having your CD called away early. But in my view, I don't really have a problem with that because if JP Morgan wants to hold on to my money for a few months, pay me a 5.7% and then give me back my money plus the interest at any time in the future, I'm perfectly fine with that. Now, to give another example of what some other CD websites look like, this is right here on Bankrate, and it shows pretty much all the same stuff. It shows different offers from different banks, offering different terms. This right here is 1 year, and you can set the terms to whatever you want, and you can sort of course by highest to lowest yield. Now, it's always important to make sure that the CD is a member FDIC because you are going to have some insurance, of course, within a certain amount of money if, for whatever chance, the bank or the CD issuer does go out of business within the time frame that you're holding onto the CD. But for the most part, in my opinion, as long as you stick with some of the bigger, more well-known, well-capitalized banks, in my opinion, you should probably be fine. Now, that being said, sometimes some of these more random or local banks will offer a higher APY. Like take this, for example, CFG Community Bank is offering a little bit higher yield than some of the others. And in my opinion, that's because you are taking on a little more risk when you are banking with something a little bit smaller. I'm not saying that CFG Community Bank isn't well capitalized. I have no clue what this bank even is. I'm just saying that for me personally, I like to stick with Bank of America or Chase when it comes to CDs for the most part. Now, a lot of you are probably asking, well, why is it worth investing into a CD even if you're going to earn a 5 or 6% when you could just buy into the S&P 500, and if history was to repeat itself, you'd be able to outperform the CD by quite a lot. And I would say to them, in short, that's a really good point. And for me personally, again, everyone has their own investing strategy and their own risk tolerance. But for me personally, I only utilize fixed income like treasury bonds or CDs when I do have capital, when I do have money on the sidelines that I'm not really planning on investing. Now, that being said, I always like to keep some of my money liquid and have some cash balance for red days when I do want to add long-term positions to my stock portfolios. But let's just say, for example, you just sold a property or you just came into some sort of liquidity event. And let's say you had 20, 30, 40, 50,000 or maybe even more sitting on the sidelines that you weren't really in a rush to invest into the stock market or a rush to invest into the next investment that you're looking to invest into. In that aspect, I do think that some of these options as of right now, like CDs, even the 1 year, or even a little bit shorter duration, or even things like the 3-month treasury bonds or something that I've been utilizing, it's an easy way to get a risk-free 5.5 roughly percent without much thought at all. So like I said, when it comes to fixed income and risk-free investments like CDs or like some of the treasury bonds that we didn't actually go through in this video, but we will be going through these in another video, so make sure to please subscribe for that. I do think these investment vehicles do have a very specific use case, but as the rates have continued to skyrocket, they're becoming more and more appealing even for younger investors like myself that just have some money on the sidelines. Now, lastly, I'll also mention that when it comes to investing or buying CDs, I've personally purchased CDs inside brokerages like Fidelity and like TD Ameritrade, and I've also purchased CDs right through banks, through their websites and other things. And take it from someone that's done it both ways, I definitely encourage everyone to look into brokered CDs because it is much easier. It's really as simple as logging into your brokerage, clicking on whatever maturity time frame you want to look at, and then right there seeing all the different banks, all the different offerings, then just clicking buy as many of them or as little of them as you want, and it's really just as easy as that. Also, what's great about doing it right through the brokerage is whenever the CD is matured, you just get paid out all your principal plus all the interest right back into your brokerage, which of course then you can use the money to invest in stocks, ETFs, or of course you could even buy more CDs. And for me personally, as of right now, I do think that interest rates are going to go down a little bit at least in the next 12 months. So I've just been buying into things like the 3-month to 1 year time frame CDs just with some cash that I have on the side. Once again, not by any means my entire portfolio, but just with some side cash, and it's worked out pretty well for me so far. But when it comes to buying into risk-free fixed income options like CDs or even like US Treasury bonds, I want to hear from you guys down below. Are these currently something that you're utilizing for your overall investment strategy? And if so, let us know down below. Is it US Treasuries? Is it CDs? Let us know in the comments. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.